Every day, the financial headlines feed you a steady diet of stock market swings, political drama, and quarterly earnings. But while you are distracted by that daily noise, the very foundations of the global financial system are fracturing beneath our feet. Retail investors keep moving cash into digital paper markets, but the architects of the financial system are moving in the opposite direction. Central banks are buying up the largest volume of physical gold recorded in decades. This diagram illustrates the risk they are attempting to mitigate: counterparty risk. This is the danger inherent in any asset that relies entirely on another party's ability to keep a promise. If you keep cash in a digital bank account, or if a nation holds billions in U.S. treasuries, that wealth is not a physical object in your possession. It is a debt. It is entirely dependent on the promise that the bank won't fail, or that a government won't devalue its currency to pay its bills. The entire world watched this specific risk play out in real time. When the United States froze Russia's dollar reserves, it proved that sovereign wealth held in digital paper could be instantly restricted or deleted by a foreign power. The realization that digital reserves were effectively an IOU, subject to Washington's approval, triggered a sharp reaction. Central banks began a systemic move toward unsanctionable physical assets that they could store within their own borders. The path to this shift began during the 2008 financial crisis. As the banking system neared total collapse, global regulators identified a structural weakness. Commercial banks were operating with almost no tangible assets to buffer against a market crash. The response was coordinated by the Bank for International Settlements, or the BIS. They are essentially the central bank for central banks, and they were tasked with drafting new rules to prevent another global freeze. They introduced a framework known as the Basel Accords. These rules require commercial banks to hold a strict percentage of Tier 1 assets, the highest quality, most stable assets on the planet. Historically, the definition of a Tier 1 asset was reserved for the state. Government-issued cash and national debt were both legally classified as the gold standard of safety. Meanwhile, physical gold was penalized. Despite its history as a store of value, it was classified as a Tier 3 speculative asset, which meant banks had to discount its value on their books. This classification discouraged banks from holding bullion. By making gold look risky on paper, the regulations ensured that banks would continue to buy government debt, artificially supporting the fiat currency system. That structural bias has been corrected by the implementation of Basel III. This new set of global banking standards effectively reverses the hierarchy that has governed finance for decades. This ledger visualization shows the core adjustment. Under Basel III, physical gold has been reclassified as a Tier 1 asset. For the first time in the modern era, it can be counted at 100% of its market value on a bank's balance sheet. This accounting change provides an immediate financial incentive for banks to hold bullion. It allows them to strengthen their balance sheets using a hard asset that doesn't carry the risk of a government default. However, this new rule is very specific. Financial products like gold ETFs or futures contracts are excluded from this upgrade. They remain Tier 3 assets because they are essentially promises. To meet the Tier 1 requirement, the bank must hold allocated physical gold. By removing the discount, regulators created a system where a vaulted gold bar is legally as valuable and safe as cash. This shift removes the regulatory middleman from the definition of wealth. A gold bar is now recognized as a Tier 1 asset, specifically because it does not rely on a banker's signature or a government's printing press to maintain its value. This explains the aggressive behavior of central banks in China, Poland, India, and Turkey. They are taking advantage of these new rules to diversify their reserves, trading their depreciating dollar holdings for physical bullion. Washington delayed the implementation of Basel III for years. When physical gold is legally recognized as an equal to the US dollar on a balance sheet, the dollar's status as the only pristine asset is gone. As debt continues to climb, the US may have to rely on its remaining gold reserves to backstop its own liabilities. This would mean shifting entirely away from a fragile system backed by endless debt to a new one firmly anchored by the physical metal. Global regulators are quietly moving the goalposts because the current debt-based model has reached its absolute breaking point. By elevating gold to Tier 1 status, the BIS has provided the legal framework for a new financial structure, one that prioritizes hard assets over paper promises. You can continue to hold digital IOUs while the very institutions that created them are moving toward gold. Or you can follow the example of the central banks and take action to secure your own tangible, physical wealth. The rules of money have been rewritten to favor those who hold the actual asset. To protect your savings, you have to ignore the market noise and position yourself in physical reality before this transition is complete.